Do you need to completely master the customers and accounts receivable section of QuickBooks Online? Maybe you're a customer manager who also needs to record transactions and manage the customer reports. Or maybe you're trying to get a job as an accounts receivable clerk or someone who manages customer records and customer transactions. Well, whatever the reason, this free video right here on YouTube is going to give you the clearest possible explanation for every possible type of customer transaction that you can possibly record into QuickBooks Online. All you have to do is watch a little bit of this fantastic video every day, and by the time you finish, you will have completely mastered every idea that you need to manage customers and accounts receivable records in QuickBooks Online. In fact, when you finish, you'll be so good at this that you will be able to send out accurate statements to your customers and be able to find and fix every possible customer and accounts receivable related mistake there is. And you'll be able to objectively guarantee that your entire set of customer and accounts receivable records are correct to the last detail. In fact, there's even a way that you could follow along with me step by step, and I'm going to tell you that really soon if you keep watching. So tune in a little bit every day and acquire a very important job skill that will help you in anything you do if you're using QuickBooks Online. Thank you so much for joining me for this very special presentation about accounts receivable and customer records in QuickBooks Online. I promise by the time you're finished, you will be an absolute expert in the area of customers and accounts receivable. You will be able to make every possible type of customer and accounts receivable transaction. You'll be able to manage all the reports that will give you everything you need. And most importantly, you will be able to prove objectively to anyone, anywhere, that your entire set of customer and accounts receivable records are correct to the last detail. In fact, we are going to cover so much material in this course that there are bound to be some things that you're not going to need, but it will still benefit you to watch them and understand them if you want to have a handle on everything you need to manage your customer records. We are going to record invoices with advanced payments, and we're going to learn how to use the special deposit tool feature of those invoices right here in QuickBooks Online. We're going to learn all about returns, refunds, and credits. And we're also going to learn about every possible type of customer discount that you could possibly give to your customers. We're going to learn about delayed charges, delayed credits, and how to print out and send customer statements so your customers can agree with you regarding what the balance is and how much each open invoice remains unpaid. And the most important thing that you will learn in this section is how to reconcile with your customers, so that ultimately you will be able to guarantee to everyone, everywhere, that your entire set of customer and accounts receivable records are correct to the last detail. Now, you could just watch this video a little bit every day and you will learn everything you need. However, for those of you who feel that they want to follow along with me step by step, there is a way that you can do that. Unfortunately, it will take a little bit of a time sacrifice to set up. But once you're set up and your QuickBooks Online account has the same numbers that mine does at the beginning of the course, you'll be able to follow step by step and match exactly what you see for better learning. Just look in the description field of this video down below the table of contents, and there are links that you can use. One link will help you sign up for free with a brand new blank QuickBooks Online account that you could then use to follow step by step. But in order for your account to have the same numbers, you would have to download the Excel file with the list of transactions that are already in the account before we begin. Now again, if you're at a certain level of QuickBooks Online, you will be able to enter all of those transactions so that your numbers are the same as mine at the start of this Accounts Receivable and Customer Records course. So it is a little bit of a time sacrifice, but it will remind you of all the other things you learned in customers and accounts receivable so that your skills are sharp and ready to learn all the advanced level things you need, and it will be easy as pie. So go ahead and download the file and record everything, or if you just want to watch and learn, that's fine too. Now, before we jump right into the material, I want to quickly mention a topic that everyone always asks about before we start learning accounts receivable. There is a topic called reimbursable expenses and billable expenses to clients. This topic overlaps into both accounts receivable and accounts payable. So because this topic does not have any additional transaction types, but only has more detail in the transactions that we're going to learn, I've decided to take that topic and make it a separate video here on YouTube. So again, look for the links under the table of contents in the description field, and you will be able to get that video. That's a special video that tells all about reimbursable and billable expenses to customers, and you will see how that topic does not add any additional transactions, but simply adds additional data to the transactions. And that's why it's a separate topic and separate video here on YouTube. But everything else you need regarding customers and accounts receivable is right here. So without further delay, I present to you our little accounts receivable adventure.
Chapter 3: Recording Refund Receipts.
A refund receipt is recorded when you refund money from a sale receipt that you previously recorded, not from refunding money for an invoice. It's the exact same steps as making the original sale receipt, but it has the opposite effect of the sale receipt when you record it in your books and records. You must use the same items that were on the original sale receipt or the same income accounts that you recorded when you originally recorded receiving money from a customer. You see, on the original sale receipt, the income account that you used when you recorded the receipt went up because you were getting paid because you earned income. And of course, your cash in bank or your undeposited funds payments to deposit would also increase at the moment you made a sale receipt because you just got paid for a service that you provided. But you see, a refund receipt has the opposite effect. The original income account from the sale receipt that you're refunding should go down by the amount that you refunded it because you did not earn that amount of income if you're giving it back to the customer for some reason. And of course, if you're giving back money to the customer, either cash in bank or undeposited funds payment to deposit must be recorded as a minus. So let's talk about our example. Back on January 18th, we created sale receipt number 4 for 16 video hours. And when we did that, video income went up because we assumed we earned all the money from those 16 hours. And of course, because we got paid, cash in bank
or undeposited funds also increased by the amount we got paid for sale receipt number 4. Now, this is what the trial balance looks like before we refund sale receipt number 4. And again, these are the numbers after the prior video. But in this example, we are going to imagine that it is now March 19th and we are only refunding 4 of those 16 video hours back to the customer, and we are going to pay the refund with check number 14. That means that video income will go down because we did not earn those 4 hours of video income if we're refunding the money back. And of course, if we're giving back money from the customer, the cash in bank or the undeposited funds should go down by the amount we give back. And I happen to know that 4 video hours totals $1,200. So when we make the refund receipt to refund sales receipt number 4, these two accounts should decrease by $1,200. So what will be the result in the trial balance after the refund receipt? Well, cash in bank will decrease by $1,200 and become $27,290. And because it's video income that wasn't earned those $1,200, video income will decrease by the $1,200 and become $48,000 even. Let's take a look at how to record it. From the top left, we click New, and we go down right under Sale Receipt and click Refund Receipt. Now, the date in our little story is March 19th of 2025. And I happen to remember that the sale receipt that we're refunding was for Betty, so we choose Betty. Now, the product or service that we are refunding is wedding video, and we are refunding 4 of those wedding videos. Now, we should add to the description of the refund receipt from number 4, so that this way, and you also have a little spell checky here, this way you will always know which receipt goes with which refund, and it will be clear. And if you do not type this in the description field, or at least the customer message, you will not know which particular sales receipt you are refunding. And most importantly, you have to choose which account you're paying the money from when you pay the customer back. So we click the pull down arrow and we choose the proper bank account that the money is being paid from. Don't forget to put in the check number of the check that we're giving to Betty for this refund. We are imagining that we are paying her back with check number 14. Now when we click Save and Close, the results in the trial balance are exactly as what we expected. It says we successfully issued the refund. We click OK. And if I take a quick minute to zoom in, you can clearly see that cash in bank has decreased to the amount that we expected, $27,290, and video income decreased to the amount we expected, $48,000 even. And one last thing to remember, a refund receipt does not change the customer's balance because the sale receipt also did not change the customer's balance. Therefore, to see this in the customer records, you need to check our very special report, Transaction List by Customer. We click in the left panel for reports. Maybe I'll zoom out a little for the audience and go down to this very important report, Transaction List by Customer. And if you scroll to the section of Betty, you will see that the refund receipt is right here at the end on March 19th. So we can see back on January 18th, sale receipt number 4, and we can see now on March 19th the refund that we just gave her.
Chapter 4. Recording Credit Memos.
A credit memo is a document that you will make if you have a return or a refund from a previous invoice. Making a credit memo is the exact same steps as making the original invoice, but it has the opposite effect of an invoice. Remember, you must use the same items or income accounts that were on the original invoice that is being credited. Otherwise, your numbers will be all messed up. Now, when we recorded the original invoice that you're making the credit for, in the original invoice, income increased because that's what an invoice does. And of course, when you record an invoice, accounts receivable and the specific customer's balance also goes up. Therefore, when you make a credit memo, the income account that you used on the original invoice should decrease by the amount of the credit memo. And of course, because the customer owes less, accounts receivable and that specific customer's balance should also decrease. Now, the most important thing to note when recording a credit memo is that you must apply the credit memo to an existing open invoice. And in business, usually credit memos are applied to an open invoice at the moment you are recording receiving payment for that particular invoice. But credits can be automatically applied to the oldest open invoice if you happen to choose that option in the company settings window. So let me show you where that is, and let us all make sure we have the same settings. Because we will not use this option. We will switch this option off so we can learn better how to manage our credit memos. So what do? Well, of course, we click the cog wheel and we open up the company settings window. And because this is an advanced class, we will go to the advanced section of the settings window and we will switch off this option because you will learn it better if you have to first apply the credits yourself. So let's go ahead and do that. From the top right, we click the cog wheel. We go over to the Company Settings tab, and in the Settings window, we go down and click Advanced. Now maybe I'll I'll zoom in a little for the audience. Now, in the section of Automation, right here, where it says Automatically Apply Credits, and that's already switched on, at least for some of you. We're going to click to open the section. We're going to click to make it not green anymore. It should be gray or light blue or whatever that color is, because we want to apply the credits ourselves. And we click Save. Now we can close the window, zoom back out, and then do our example. So, let's imagine on March 20, we gave Candy 3 video hours credit for invoice number 12 that was made back on March 1. Well, we know that video income, which was the original income account on the invoice number 12, should decrease because invoice number 12 increased video income when we made it, so when we give credit against it, video income goes down. And we also know that a credit memo decreases what a customer owes. So accounts receivable and Candy's specific balance will decrease at the moment we make this credit memo. And I happen to know that 3 video hours equals $900. So if these are the numbers after the last video, and we are decreasing these 2 accounts for $900, what will be the result in the trial balance? Well, accounts receivable will decrease by $900 and become $23,040. And because video income was the original account on the invoice, video income from this credit memo should decrease
From
by
the top
$900
we
and
click
become
New
$47,000 and go down to credit memo. Notice it assigns number 15, which means the automatic enumeration is the same enumeration that goes along with the invoices. The last invoice was number 14, so this assigned number 15. And you can change it to anything you want, but we'll leave it. The customer is Candy Charles, and the date is March 20 of 2025. Now, the product or service that she's getting credit for is video, and it's 3 video hours. Now, you can add to the description field which invoice this credit memo is intended to be applied to. That might help later on. And once you have all the information, all you have to do is click Save and Close. When we go back to the trial balance, the results are exactly as what we expected. You can see that accounts receivable has decreased to $23,040 and video income has decreased to $47,100. Now, of course, you also have to check the open invoice report because we changed the defaults in the company settings so that QuickBooks Online would not apply that credit memo to any of these open invoices. So that credit memo should still show on the open invoice report in the bottom section of Candy. So we scroll down and click Reports, and we go to the open invoice report, and you can see that the credit memo that we just made is still there because it has not yet been applied to any of the balances of Candy's other open invoices. Now, you must know how to manage a credit memo in a situation where the customer will decide much later which invoice to apply it to. So let's imagine on March 22nd, we gave Betty 1 editing hour credit, and Betty will decide later which invoice she would like us to apply it to. Well, we know editing income will decrease because that's what happens when you put the editing item on a credit memo. And Betty's balance, her specific balance and accounts receivable will decrease because we all know that a credit means the customer owes us less. So let's go ahead and record the credit memo now. From the top left, we click New Credit Memo. The customer is Betty Boop, and the date is March 22nd of 2025. The product or service in this case is editing, and it already shows 1 hour. So all we have to do in this case is click Save and Close. And we know that if we click Reports and we open up the trial balance, that $140 credit has decreased editing income. And we can check it by double-clicking and going to the very bottom, and you see the credit memo we just made was the last transaction in the editing income account, and it decreased the editing income. It also, it also decreased accounts receivable. And if you double click and you go down to the bottom of accounts receivable, the credit memo we just made was the last transaction recorded, and it decreased it by $140. So now it's March 23rd, and Betty has finally decided which invoice she would like the credit applied to. And she specifically requested that we apply that credit to invoice number 12 that's due on March 10th. And because we are applying this credit memo before Betty is paying, we have to make what I call a $0 payment. In other words, to apply a credit memo without actually paying an invoice, we must use the receive payment window just like we did before, and we must apply the credit as if we were paying the rest of the invoice. All we have to do in this case is do exactly what we did before, but make the money amount of the payment 0. This will apply the credit to the invoice without changing any of the customer or account balances. And that's exactly what we want. We still record it as a payment with $0 like any other payment. So what will happen in the open invoice report at the minute we apply this credit memo here to this invoice here? Well, the credit memo will completely disappear from the open invoice report because it's already applied. And the credit memo it's applied to will decrease by $140 and become $2,100. From the top left, we click New, Receive Payment. We make sure the date is March 23rd of 2025. That's the day that we are applying the payment. And we click the customer, in this case Betty. Now you may see the check marks in different places, but apparently the current default is for QuickBooks Online to apply the credit memo that's sitting here to the oldest invoice. And it doesn't know that we want to apply it to the next invoice. So the way to fix this is to first uncheck the wrong one and then recheck the invoice that we want the credit memo applied to. Now, after we do that, we have to change the money amount that by default is the whole invoice to just the amount of the credit memo. So we highlight the money amount and type in only the digits 140, and then on the left of the keyboard push tab. Now we'll tell QuickBooks Online that this credit memo is what's being applied. So we click the check mark, and the only two check marks you should have is the check mark on the credit memo that we're applying and the check mark on the invoice that we're applying it to. And once these money amounts are both as you see here, now we can click Save and Close. Now, when we go back to the let's refresh this. When we go back to the open invoice for Betty, you can see that for Betty, the credit memo has disappeared from the open invoice, and you can see that the March 10th invoice has now decreased by the $140 and only shows up in open invoice for $2,100.
Chapter 5. Refunding a paid invoice.
When refunding a paid invoice, some people think that you can make a refund receipt like we learned earlier in the course. Well, you cannot. You cannot simply make a refund receipt, and that's because if you do that, you will not have a record of the refund in the customer's account balance. And very often customers want to see the effect of the refund in the balance. And the other reason is that sometimes there's a long time or relatively long time between the moment you formally declare the credit is justified and the moment you actually pay the refund. And again, the customers want to see the adjustment to the balance and the credit memo. So, when refunding a paid invoice, some people think that you can make a refund receipt. Well, you cannot. And there are several reasons. One reason is that if you do it that way, you will not have a record of the refund in the customer's account balance. And some customers want to see the effect on their balance of the refund. Another good reason is that sometimes there's a long time or relatively long time between the moment you formally declare that the refund is justified and the moment you actually pay the refund. And customers and management want to see documentation between those two dates. And there are other reasons as well why you simply cannot make a refund receipt. Now, there are 3 simple steps to refunding a paid invoice. First, you make a credit memo for the customer exactly the way we learned in a prior video chapter, and follow all the rules about having that credit memo match the original invoice. Then you have to physically write a check for the customer and send it out. That's in step 2. Then the third and final step is to use the receive payments window to apply the refund check to the credit memo. Then the two of them cancel each other out regarding the customer's balance, and then everyone has all the documentation that they need. But you may well ask, what happens in your books and records after each of these 3 steps? Well, on the original invoice, the income went up and the accounts receivable went up. So after step 1, when you make your credit memo, the original income account will go down by the amount of the credit, and so will accounts receivable and the customer's balance. Then, in step 2, we refund the customer their money by writing a check. And of course, when we write a check and pay a customer, cash in bank goes down because we just paid. But interestingly enough, when you pay a customer, their balance goes up because you gave them money. You see, if a customer paid you, their balance would go down. So logically, if you're paying a customer, their balance goes up, or at least goes up temporarily. Then, in step 3, you apply the check you wrote in step 2 to the credit memo that you made in step 1, and they cancel each other out. What happens is, you're going to use the receive payment window to apply one to the other. And then this way, everything gets recorded properly, and you will not have any open balances for any transactions in your open invoice report. For example, let's imagine on March 23rd, we granted Betty's request for a refund for the January 2nd invoice, which is invoice number 2. And I happen to remember that the amount of that invoice was $1,400. Well, what will happen after step 1? The accounts receivable will go down only after step 1, because after step 1, you're making a credit memo just like we learned in a prior video. And of course, the credit memo reduces the income account that the invoice originally increased. So let's go ahead and record that credit memo. From the top left, we click New Credit Memo. The date is March 23rd of 2025. The customer is Betty. The product or service is Editing 10. Now again, it might be helpful to type here in the description field which particular invoice this credit memo should be applied to. And now we click Save and Close. And you can see right now on the Open Invoice Report, Betty now has this credit memo. And now when we do step 2, writing a check, accounts receivable will increase. And that's because when a customer pays you, their balance goes down. So when you write them a check, their balance goes up. And of course, if you're writing a check, the cash in bank goes down. And when we write this check, we're going to do something special. When we write a refund check, we must use accounts receivable as the account that we put in the category field. And on the same line, you have to put the customer's name in the job field. So the date we're writing the check is March 23rd of 2025. So we click New, Check, and we see it remembers March 23rd of 2025. The check is to Betty. It's coming from the correct bank account, just like we learned. And what we put here is accounts receivable. Accounts receivable. So we click category and we choose, or you can type in to filter, accounts receivable. Put the amount we are refunding, and most importantly, you have to choose the customer that you're refunding in the customer job field. And you remember from the prior course how to activate this field if you do not see it in the check window. You would have to remind yourself of what you learned in the previous course about going to the account settings or company settings window and tracking expenses by customer. So we click Save and Close. Now, after step 2, we're going to print or save the open invoice report so that you and the customer can see the effect on the customer's balance. And when we look at the open invoice report after step 2, you see that it clearly explains that Betty legitimately received the refund. You see the credit memo that reduced the balance as a negative, and then the check that we wrote to Betty that removed that, so the net effect of both of these transactions is 0. But if we print this section of the open invoice report and we send it to Betty, this is the proper documentation that will clearly explain to Betty exactly what her balance is. It shows that she did get the credit for the invoice we refunded and did receive the check that we sent, so the net effect is 0, but we have a clear explanation of exactly what happened when we refunded the paid invoice. Then, after you save that, you can do step 3. You can actually apply the credit memo to the refund check by making a $0 payment, just like we learned in the prior video. So, we click New, and we go down to the Receive Payment window. Make sure the date is the same as the other 2 recorded transactions, because QuickBooks Online will record a $0 payment on this date. We choose Betty Boop, and then we scroll down, and again we see that the negative numbers are down in the bottom section by credits, and the positive numbers are up here in the invoice section. So just like it was before, QuickBooks Online assumes that the credit memo is to be applied to the oldest one. It doesn't know what we're doing. So we have to first uncheck the wrong one before we recheck the correct one. And in this case, we're applying the credit to the check, but we're still applying the negative number to the positive number. So you also have to click this credit memo to tell QuickBooks Online that this credit memo is being applied to this check. And don't forget, the amount received must show 0 because this is a $0 payment, and the only action we're taking is applying these 2 transactions together. When we click Save and Close, we can refresh the open invoice report, and we can see that both of them have disappeared from the section of Betty because they have been applied together. But notice, Betty's balance is the same because the balance does not change when we simply apply a credit memo to a check or an invoice. And finally, we confirm the final numbers in the trial balance after this lesson before moving on to the next lesson.
Chapter 6, Customer Down Payments and Prepayments.
Do your customers sometimes pay you before you give them the product or service that you sell? Well, then you need to know how to record customer deposits, down payments, and prepayments. Down payments, deposits, and prepayments all mean the same thing, but they're called down payments or deposits if an invoice is partially paid in advance, and it's called a prepayment if the invoice is completely paid in advance. Now, there are actually two ways that you can record receiving advanced payments from customers. One way is what I call the QuickBooks Desktop method that does not use the special deposit feature in QuickBooks Online. Then the other way is what I call the QuickBooks Online method, which does use the special deposit feature that comes with QuickBooks Online. You see, the desktop method is the recommended method, and that's because it will work with any accounting system, whether you have the job deposit feature or not. It keeps more accurate and detailed records, and it keeps your records updated as well. And this method also has more information about the job deposit when you run the reports. However, the QuickBooks Online method is more convenient because it does utilize the special feature that only comes with QuickBooks Online. But don't worry, I'm going to demonstrate exactly how to use that job deposits feature in the video that follows this one. So, in this video, we're going to use the desktop method, and I also call it the old-fashioned way. So let's say the customer pays before receiving the product or service. Therefore, the service is owed to the customer until it's delivered. We use the receive payments window just like we would if the invoice were already made. But because there is no invoice this time, at the moment we receive the payment, QuickBooks Online can print a credit memo that you can give the customer as a receipt and proof of the payment you received. Then you can print it or give a separate receipt from Excel or any other source at the moment the customer pays. So, what happens in the accounts when the customers pay in advance? Well, we know that if we get money from a customer, their balance goes up. If we get money from a customer, the bank balance goes up. The customer's balance goes down, and you could temporarily have a negative balance in the customer's account until the job is done. And the payment stays in the customer records as what we call an unapplied credit. And you saw an example of that in earlier videos. Now, let's do an example using the old-fashioned method. Let's imagine on March 24th, Alan paid us $700 cash in advance of a future job, and let's imagine that this future job has nothing to do with any of the open invoices, has nothing to do with any prior job. We will record this in the receive payments window, and we will record it directly deposited into the bank account. We will not apply this payment to any open invoice, and that's why it will generate a credit memo. From the top left, we click New, Receive Payment, and we make sure that the date is March 23rd in our little story. March 24th, actually. And the customer is Alan. Now look what happens when we choose Alan. We get his open invoices. Now, the payment method was cash, and it goes directly into the bank, and the amount we received was $700. Now notice, QuickBooks assumes we are applying it to an invoice, but we are not yet, because we specifically stated that the existing invoices have nothing to do with this down payment for a future job. So you must click to remove the check mark, and when you're ready to save the window, you should have money in the received field, but none of the invoices selected. Save and close, and it says, we'll save this payment as a credit since you did not select an invoice. Save as credit. And we can check this on the Open Invoice Report. Reports, Custom, Open Invoice. And here's the section of Alan, and you can see here's the payment, and you can see the reason it's on top is the teacher forgot to put the right year. So let's just rectify that now. And then the Open Invoice Report, save as credit. The Open Invoice Report will show it properly in date order. So if you didn't make the mistake, yours would be the last transaction listed. And here it is. And again, it's only on the Open Invoice Report because it has not yet been applied to an invoice. So now let's imagine that it's March 25th and we did 15 editing hours for Alan, and Alan would like us to apply the $700 payment that we just made the day before. Well, we can make the invoice just like we learned, but as soon as we finish making the invoice, we have to go to the Receive Payments window and apply the prior payment. From the top left, we click New Invoice. And of course, we have to make sure that we choose Alan, and the date of the invoice is March 25th, and we have to make sure that we choose editing in the quantity 15. Now again, we click Save. Then of course, actually you can click Save and Close. And when we go back to the Open Invoice Report, you can see that the new invoice dated March 25th is right here for $2,100. And we still have the $700 payment that we need to apply. From the top left, we click New and go down and click Receive Payment. Now we choose Alan Arby, and of course we keep the same date, and notice what QuickBooks Online did. It assumed that the credit that was available should be applied to the oldest, but we have to correct this. We have to uncheck the wrong one and then recheck the correct one. It's not that easy because if you click the box, it assumes you're using the entire amount. You have to overtype with just the amount you're applying to that invoice. So you have to also be careful about what QuickBooks Online put up here. You have to type 0 yourself when you make a $0 payment. So when you finish, before you save this window, the amount received has to be 0, and the amount of the invoice and credit or payment has to be the full amount that you're applying. 2 700s here and 0 here, and click Save and Close. And when we come back to the Open Invoice Report, you can see the payment is gone and the invoice we just created has been decreased to $1,400. Now I'd like to close with one technical point about the accounting. If you need to report your financial statements after receiving the down payment, but before the job is done, remember, during that period of time, you technically owe the service back to the client. So if you're making financial statements between those dates, you will need to make a typical, normal accounting adjustment, which is usually a journal entry, to move the negative balance of any customer's accounts receivable records into an account called unearned income. And again, you don't have to worry about it if you're not presenting formal financial statements between those dates. And if you are, you'll usually have a CPA who will know the adjustment to make. And don't forget to confirm your final trial balance numbers before moving on to the next video chapter.
Chapter 7. Using the QuickBooks Online deposit feature.
Sometimes when customers pay in advance, they want both a receipt for the deposit they just gave and an invoice for the entire balance of the job right at the start of the job. QuickBooks Online provides the QuickBooks Deposit feature so they can satisfy this condition. And when we use the deposit feature in QuickBooks Online, it must first be activated in the company settings window. You see, we click the cogwheel and we click company settings, but remember, if you're using the Plus version of QuickBooks Online, it's called account settings, but it's in the same place and it does the same thing. Once you open the settings window, this option is in the sales category, and all you have to do is click to activate by clicking the word on right next to the word deposit. And once you do that, it means the next time that you open an invoice, there will be an additional box at the bottom right of the screen just for you to put in the amount of advance payment or job deposit that the customer gave in order to reduce the invoice right at that moment. So let's go ahead and activate it now together. Now, before we activate it, let's take a look at an invoice to make sure that it does not yet have the job deposit box. If we click New, Invoice, and we go to the bottom right, you can see that this is the original box for sales tax that you can learn about in a different course from this one. Now, when we close it out, we can reopen the settings window by clicking the cogwheel in the top right, going over to where it says either company settings or account settings, and opening up the settings window. Now, once you're in the settings window, click the sales category, and you can clearly see this section for sales form content. Clicking once anywhere in the section allows you to edit the options, and this is the one that we want. So on the same row as deposit, click to make the option green to indicate that it's active. Now click Save in the section, and don't forget to click Done at the bottom of the window. See right here, Done. Now that you click Save and click Done, you can click New, Invoice, and when you look at the bottom of the invoice, you can see QuickBooks Online has added the deposit feature with a little box for you to put in the customer's payment. So what exactly are the steps for using this job deposit feature in QuickBooks Online? Well, you have to create the invoice for the whole entire job on the day that you receive the deposit or down payment. You record the amount received in the field for deposit. That's what it's for. QuickBooks Online will deduct the amount of the deposit field from the total. and you can give the client the invoice as proof of payment for the deposit. It will show the decrease for the deposit and the remaining balance. Now, they already have the full invoice as a request for payment when the job is done. So that's another added convenience. So clearly you're going to put the money amount that the customer paid you right there in the bottom right, because that's what it's created for. And it's specifically intended to receive advance payments for the invoice that you're making. But what I just said should sound like a little bit of a contradiction to people who have a little experience in accounting. Think about what the job deposit box does. You see, job deposits are supposed to be in advance payments before the job starts. However, when you record an invoice, QuickBooks Online will record the entire job's income as already earned. So that's a bit of a contradiction. You got paid before the job started, but you recorded all the income as earned. How could both be true? Well, how could both be recorded at the same time? Think about it. I got a payment before the job started, and I recorded the advance payment, and now it indicates that I already earned all the income. So, why do we do that? We do that because this idea comes from how bookkeeping was done in the days before the computer. In the days before the computer, some companies' clients needed a receipt for the advance deposit for the job, and companies wanted to give a document explaining and requesting the remaining amount unpaid so that it's clear to the client what they're going to have to pay when the job is done. So what happened was the invoice became both. It became the formal request for payment and became a receipt that proves that the customer paid some money in advance. So we can record them together at the same time in QuickBooks Online because some clients expect them to be recorded together and received together. So what happens when we record an invoice and actually use the deposit feature? Well, when you record an invoice, the income increases by the entire amount of the invoice. The invoice amount comes from the total of the items, and the items go into the income accounts. So the income will increase for the total amount, and QuickBooks Online will assume all of that income is earned. What else will happen when we record an invoice and use the job deposit feature? Well, we just got cash from the customer, so obviously cash in bank or either undeposited funds will increase by the amount received. So if you take the income earned and you deduct the amount received, the difference is what's still owed. So the difference will increase accounts receivable for the amount of the invoice that's unpaid. And these are how the numbers will change. For example, let's imagine on March 26th of 2025, Candy paid us $900 cash in advance for a future job that will in fact be 15 video hours. So here's a situation where we're using the job deposit feature, and now let's crunch the numbers. I happen to know that 15 video hours would be $4,500 in video income, and that would be the full amount of the invoice. Now we received $900 cash as the in advance job deposit down payment. Therefore, $3,600 is still owed as the balance of the invoice. And these will be the three numbers that change the chart of accounts and the trial balance. So what will happen in this particular case when we record this invoice with the job deposit feature? Well, the income earned will increase by the full amount, $4,500. The cash in bank will go up by the amount we physically received, and the difference, which still remains owed on the invoice, will increase by $3,600. So what will be the result in the trial balance when we record this invoice? Well, we just earned $4,500 more in video income, so for the total balance of the invoice, video income will increase to $51,600. And we just physically deposited $900 more into the bank account, so cash in bank increases by $900 and becomes $29,890. And the difference of $3,600 is still owed on the invoice, so accounts receivable increases by that amount and becomes $25,500. Let's take a look at how to record it. From the top left, we click New, Invoice.
And of course, the customer is Candy. The date that we're making this invoice is March 26, and the product or service is video weddings. I happen to remember that it's 15 video weddings. Now, notice everything seems the same except when we go all the way down here, we're going to put the money amount we received in the new deposit field. So we click here and type in 900. Okay, you can type it in. I was practicing before. So now notice when we push tab, it's going to ask us which bank type of account are we going to physically deposit the 900 into. And in this example, we're going to choose the undeposited funds account. It's actually this field that we tell QuickBooks Online, are we going to put it in the bank, put it in cash on hand if the customer gave us cash, or is whatever money they're giving us going to sit here in undeposited funds? And that's the way it's going to be in this example. So now all we have to do is click Save and Close.
We can open the trial balance and see the results are exactly as what we expected. Cash in bank went up to $29,890, accounts receivable went up to $25,500, and video income increased to $51,600. Now, the open invoice report should still show the net amount of the open invoice, which is the total of the invoice minus the deposit the customer gave. We know that amount is $3,600. So we will go to the Reports menu and go down to Open Invoice, scroll out a little for the audience, and when we go down to Candy here, we can see that the invoice we just created has a remaining balance of $3,600. So in continuing with this example, let's imagine that it is now March 28th and we finished the 15 hours of video that was invoiced with the $900 deposit that we received. What exactly do we do when the job is finished and we're using this method? The answer is we do nothing. There's absolutely nothing else to do. That's because the income from the job has already been recorded, and it was recorded the minute we made the full invoice. You might want to reprint and resend the invoice because you might want to remind the client that the job is done and it's time to pay, but there's no additional entry to record because everything has already been recorded. Now let's close with a very important note about this topic. All methods of recording prepayments and down payments require an adjustment when formal financial statements are being prepared. In this case, income is recorded as earned before the job is done. That's what's happening when you use this special deposit feature. It also records the balance of the invoice owed before the job is done. So because of that, if you must report your financial statements, I mean formal financial statements, and they have to be reported after receiving the deposit, but before completing the job, then you will need to make a normal accountant adjustment, which is usually done by a journal entry. You will have to decrease the earned income because the job is incomplete on the day you report your statement numbers. And you will have to decrease the accounts receivable because the job money is not yet owed on the day you report your numbers because you did not finish the job. The amount of the adjustment is the money amount of the unfinished work from the saved invoice. So one way or another, you will have to make an adjustment if you collect prepayments and down payments and have to report formal financial statements.
Chapter 8. Discounts to Customers.
There are two kinds of discounts that you can offer your customer that can be recorded at the moment of the sale. You can offer them what's called a qualifying sales discount. That means the discount they receive it at the moment the service or merchandise is given. And it's usually a sale or a discount for a specific reason. For example, an employee discount, or a family discount, or a Black Friday discount, and so on. And the discount amount is usually some specific amount that you clearly state to the customer, or a specific percent of the service or merchandise being sold. The other type of discount is what's called an early pay discount, and that's a special type of discount. It's always a percent of whatever the balance of the invoice is, and it's only for invoices, not sales receipts. That's because an early pay discount means that the customer receives the discount if they pay the invoice within an agreed upon number of days. And you must put the terms of the discount on the invoice on the date of the sale. Now, in this video, we will not learn about early pay discount. We will only learn about the first type of discount, which is also called a normal discount. It means if the sale qualifies for the discount, you give it to the customer. You can have a separate account in the chart of accounts to track the amount of each type of discount that you give. For example, you could have one account for employee discounts and one for Halloween discounts. So you can compare how much money you lost on giving employees discounts compared to how much money you lost giving customers discounts because it's Halloween. In QuickBooks Online, the account type you choose to track these discounts is called an income type of account, and the detail type is specifically discounts and refunds given. So why would it be income and why would it be detail type discounts and refunds given if in fact you're giving your customers a discount? Well, this comes from accounting theory. You see, discounts are what they consider to be contra income accounts, and they should show up on the income section of the profit and loss. And even though they take away from income, they're still in the income section because they help you derive the net amount of your income. Let us set up these two types of discounts. First, we'll set up what we call a good customer discount. And if we feel the person is a good customer, we'll take $20 off at the moment of a sale. The other type of discount we'll call Thanksgiving Day sale. and that means it's 10% of the balance of the invoice. So here are two typical qualifying sales discounts that a company could offer and two ways to track them separately. So the first thing we need to do is set up an account in the chart of accounts for each of the two discounts. For the good customer discount, we'll call it good customer discount. The type will be income, and the detail type will be this special type here, discounts refund given. So we go to the chart of accounts by clicking the cog wheel. We come across to the left where it says settings, and we go down to chart of accounts.
And then we click New. Now, the name of the account that we will first put is Good Customer Discount. And as mentioned a moment ago, this is an income type of account. And the detail type is discounts refund given. And again, we do this for reasons that I mentioned. And then we can click Save and New. Then the screen clears the name, and luckily in my case, conveniently left the account type and detail type, which are going to be the same for the next one, Thanksgiving Day discount. And for this one, we can click Save and Close if it lets us, or just Save. And if we come back to the chart of accounts and view only the ones created by us, you can see that these two accounts have just been added to the chart of accounts. And now let's set up the two items on the items list. We go to the cog wheel and we go to the column of lists and click Products and Services. Now, the first one we're going to add when we click New is going to be a service. So discounts are services or service type of items. And of course, the first one is named Good Customer Discount. And the most important thing is connecting it to the proper income account. And the proper income account, as we know, is Good Customer Discount. Then, of course, we can click Save and New. And here it is in the list of products and services. And then for the next one, also a service, we choose to type in Thanksgiving Day discount. And logically, that should be connected to the Thanksgiving Day discount income account that we just created. This time it lets us click Save and Close. And now we have the two items on the items list that we can use to give discounts to the customers.
Let's try some transactions. Let's imagine on March 27, we did 11 video hours and 5 editing hours for Alan. He paid us directly into the bank account. He gets the Good Customer Discount of $20. So let's go ahead and record this. From the top left, we click New, Sales Receipt. Now to be clear, this is our 10th sale receipt. So regardless of how your QuickBooks Online enumerates by default, make this sale receipt number 10. And it is to Alan Arby for video hours. Oh, excuse me, we have to put the date, March 27th of 2025. And the first product or service is Video Wedding 11. Then on the next line, Editing 5. Don't forget This money is directly deposited into the bank account, but the most important point in this sale receipt is all the way down here. When I click under the last item, I can choose Good Customer Discount, and I put in the amount as a negative number, minus $20. Notice when I push tab right here, you can see the subtotal decreases by $20. Therefore, the invoice is only $3,980 and Good Customer Discount is recorded as $20. When we click Save and Close, we can open the trial balance and see that the results are exactly as what we expected. We can click Reports, Trial Balance, and scroll down to notice that Good Customer Discount shows up for the first time as $20. Notice it's on the debit side because normal income is on the credit side, and it will get subtracted from normal income when we run the profit and loss. So let's try a second example. Let's imagine now on March 28th, we did 14 editing and 8 video for Candy. She gets the Thanksgiving Day sale discount because it's March 28th, and that's 10% of the entire sale. And let's imagine she also paid us directly into the bank account. From the top left, we click New Sales Receipt, and it should automatically enumerate to number 11. This customer is Candy, and the date is March 28th of 2025. We did 14 editing and 8 video. And of course, under all the other products, we click and choose the Thanksgiving Day discount, which is right here. But now here's an interesting point. Of course, you're going to put a negative number. However, when it comes to a discount that is a percent of the sale, you must calculate the amount yourself. Only calculate the amount of the discount. You don't have to do the math for the final balance of the invoice, but it should be pretty easy to find 10% of a number. So we know if the subtotal before the discount is $4,360, then the discount should be $436 if it's 10% of the whole invoice. Push tab, and you can see that QuickBooks Online, of course, subtracts whatever's in the discount field from the whole invoice and gives you this net amount. When we click Save and Close, we can go back to the trial balance, and we can see that Thanksgiving Day sale showed up for the first time as $436. Now let's close with one more example just to enhance the learning. Let's imagine on March 29th, we did 4 video hours and 4 editing hours for Betty. She paid us directly into the bank account, and she gets the Good Customer Discount of $20. From the top left, we click New Sales Receipt. The date is March 29th of 2025. Now, we're going to do video 4 and editing 4. And just like last time, The good customer discount comes at the bottom, and we put a negative number, minus 20. And notice it gets subtracted out from the total at the bottom. And when we click Save and Close, and we can see that good customer discount increased to $40. And if we double click, we can see that that $40 came from two separate sales receipts. It came from the 27th and 29th for each of these sales receipts, respectively.
Chapter 9. Giving special early pay discounts.
Now, in order to give the early pay discount to a customer, you must record an invoice with the terms that are chosen from the terms list. The discount is given and recorded on the day that they pay, not the day that you record the invoice. Do not give the discount on the day that you create the invoice. And you have to be very careful because many people make this mistake because they see the discount box at the bottom of the invoice window. For example, let's imagine on March 30th, we did 18 editing hours for Betty and we're going to send her an invoice. And we're going to put on the invoice the terms that we created in the prior video chapter, 310 net 45. From the top left, we click New, Invoice. We're actually up to invoice number 20. The customer is Betty, and the date is March 30th of 2025. The item is editing 18. Now, the only difference between this invoice and the prior invoices that we created is that on this invoice, we're going to choose the terms that we created in the prior video chapter. It's right here on the list, just like we saw. We click on it, and now we're ready to save the invoice. And most importantly, do not put a number in the discount percent box. You do not put a number in that box at the moment you create the invoice. You will only put something there if they are entitled to the discount, and you will not know that until the day that they pay. So we click Save and Close. And when we look at the Open Invoice Report, you can see the results. We click Reports, Open Invoice, and we scroll down to the section of Betty, and now we see this is the first invoice where the terms are what we created. So now how do we actually give the discount? Well, we made the invoice and we put on the terms, and we did not do anything else yet because the discount is given on the day that it's paid. And the person who's recording the payment must do the following 6 steps. They must reopen the invoice right from the payments window when they're recording the payment. Check the terms that are listed on the invoice. Determine if the customer is eligible for the discount based on the date of the invoice and the date that you got the money. If they are eligible, then you must put the discount percent in the discount field. Then save the invoice, and then immediately upon saving the invoice, record the customer's payment. These 6 steps have to be followed exactly for the early pay discount to work. For example, let's imagine on March 31, Betty paid in full for the invoice that we made the prior day. So, from the top left, we click New, Receive Payment. And at the moment that we choose our good customer, Betty Boop, we see the 3 invoices that are open and the one that she's paying for. Now, in order to determine if they're entitled to the discount, you have to double click right there on the invoice
Don't worry, we'll come right back to the payment window. For now, click yes. We go over to the invoice and we simply compare the terms to whatever today's date really is. And when we compare the invoice date to the terms and today's date, we determine if Betty is entitled to the discount. If the answer is yes, and only if the answer is yes, we scroll down a bit and we put in the discount percent according to the terms right in the discount percent box. If the terms say the discount percent is, what does it say? It says 3% right here. That means that 3 is the number we put in because QuickBooks Online expects a percent. We type in 3 and push tab, and notice QuickBooks Online automatically calculates the amount of the discount and subtracts that discount from the invoice total. So now, right before we record the payment, the balance of the invoice changes slightly. And when we click Save and Close, we can see that the open invoice report now reflects the fact that the invoice balance has changed. And as I said before, you must record the payment at the moment that you change the invoice. Those two things go together. But I'm not going to do that yet because I want to show you something quickly. At the instant that you change the invoice, and even though you have not yet recorded the payment, you can still go to the trial balance and you can see that the discount has already been recorded in the chart of accounts. That's because you changed it on the invoice. But remember, you can't do that without immediately recording the payment. So we have to come back to New, Receive Payment. Maybe we'll zoom out a little. And as soon as we choose Betty Boop, we can see the 3 invoices and now the new balance. The new balance. And if Betty did what she's supposed to do, all we have to do is click the check mark and the amount of the balance of the invoice should be equal to the amount of payment that we got from Betty, because Betty knows how much to pay us if she's entitled to the discount. So this should be the amount that we physically received. Notice how easy it is to click the check mark if that's the balance of the invoice. And now all we have to do is make sure the date is the date that we received the payment, which of course is 1 day after the invoice in this case. And when we click Save and Close, we can see that all the numbers in the trial balance are correct. The discount is still here. Cash in bank increased to $41,978.40, and accounts receivable decreased to $25,500. So if we close by taking a look at the open invoice report, you will see that the invoice number 20 has completely disappeared from Betty's balance.
Chapter 10. Managing Customers' Bounced Checks.
What happens in your records when a customer bounces a check? Well, we know that your cash in bank is decreased by the bank for the amount of the bounced check. And your bank account actually goes down even further because your bank will charge you a fee because someone else bounced a check. But technically, that money is still owed to you from the customer. And we know that the account that represents money owed from the customer is accounts receivable. So at the moment the customer bounces a check, cash in bank goes down and it should be placed into accounts receivable for the amount of the check, and you should also add a service fee to the amount you increase accounts receivable, because you really should charge your customer a fee because your bank charged you a fee because of the customer. So there are 3 things in your records that need to be corrected when a customer bounces a check. First, your bank account must be decreased by the amount of the bounced check. This amount must be added to the customer's balance in accounts receivable. You must record the fee that the bank charged you as a result of the bounced check, and you should charge a customer a service fee for the service of managing the bounced check, or at least to cover the bank fee that the bank charged you. So let's take a moment to set up for this. You must first add an item to the list of products and services and connect that item to the bank account, specifically the bank account that was affected by the bounced NSF check. Let's call it Customers Returned NSF Check, and let's make it a service item because we're providing a service to our client by managing their NSF check. From the top right, we click the cog wheel. We go over to the list of lists and click Product and Services. Now, we have all the other items we had put in previous videos, and now we're going to click New. And we're going to make this a service because we're managing the bounce check for the client. And we're going to name it Customers Returned NSF Check. You can pause the video to type it in, but the most important thing to remember is that it does not get connected to an income account. It gets connected to the bank account that was affected by the bounce check. Then you click Save and Close. Now we're ready to at least start our example. And this example will be more broken down than the way you would normally do it. But once we learn each step, you'll see how you can do them together and how easy it is to do in a real situation. For example, let's imagine on April 1, we received a notice from the bank that check number 5678 from Candy, dated March 6th and deposited on March 9th, has been returned as NSF check. The amount is $2,660. Your bank charged you a $30 fee for someone else's mistake. So the total amount of the decrease of your account is both the amount of the check and the amount of the fee, both happening on April 1. So let's examine step number 1. Your bank account must be decreased by the amount of the bounce check because that's what the bank put in their records, so that's what you have to put in yours. And the amount must be added to the balance of the customer's account because at the moment the customer bounced the check, they owe you the money, and that should be reflected in accounts receivable. All you have to do is make an invoice for this customer dated April 1, which is the day the bank deducted the amount of the bounce check from your account. This will do two things. First, it will correct the balance of the bank account for the bad check deduction, and then it will allow you to give an invoice to the customer in order to bill them for the bounce check. And the reason it works so perfectly and smoothly is because you're going to put on the invoice the item that you just put on the list of products and services. So let's take a look. From the top left, we click New, Invoice. From the top left, we click New, Invoice. The customer is Candy. The date is April 1 of 2025. Now the item is the new item we just created, Customers Returned NSF Check, and the amount is, push tab, And it might be helpful to add to the description field the check number of the customer's check that bounced. And we scroll down and click Save and Close. You can open the trial balance. You can come down to Reports, Trial Balance, and you can see the cash in the bank has decreased by the amount of the invoice we just made. And you can double click and you can go all the way to the bottom here where it shows the April 1st invoice and see the last transaction decreased it by the amount that we just invoiced the customer. Now, step 2 only takes 2 seconds. You must record the fee that the bank charged your account as a result of the bounce check. And very simply, use the expense window the way we learned before, and the amount is $30 charged on April 1, transaction number 181818. No problem. So we can click New, Expense, just like we learned before, and you don't have to put a payee, or you could put the bank as a payee, but make sure that you're recording it in the correct bank account, the account that the bank charged the fee, reference number, and you could make a separate expense account in the chart of accounts for bounce fee expense that the bank charges you. But most companies don't have that many customers bouncing checks, so very often they can put it into the bank fees expense type of account. It's really up to the business how to put or how to decide the category. But we know the amount is what the bank charged you. Couldn't hurt to associate it with a specific customer. And now when we click Save and Close, and we can see that bank fees expense shows up for the first time as $30. And if we scroll up to the cash in bank balance, double click cash in bank, you can see that $30 has decreased the cash in bank by the amount of the expense. Now again, you really should charge your customer a service fee for the service of managing this bounce check. So we have to go to the chart of accounts and make an other income type of account in the chart of accounts, and we can call it income from NSF check processing. From the top right, we click the cog wheel and we go over to the settings column and click chart of accounts. We're making a new account, and it's an income type of account, and the subtype is other income. You can other income, and of course other miscellaneous income is also the detail type, which is also called the tax form section, and the account name will be income from NSF check processing. And you can pause the video if you need a second to finish typing and click Save. And now the last setup step is to make the service item that you are charging the customer, and let's call it processing fee for return check. So again, we go back to the list of products and services. We click the cog wheel. We go to the column of lists, products and services. Now this is a new service. Click New. We make it a service, and the name of it is exactly what we said, processing fee for returned NSF check. And of course, we're going to connect it to the income account that we just made. Scroll all the way down to the bottom to get the other income section and choose the account. Now, before you click Save and Close, you could scroll down a little more and click Edit Sales Tax. Some of us have the default that every item is automatically taxable. So after you click Edit Sales Tax, scroll down. And if you click Non-Taxable and click Done, then it will no longer bother you when you make an invoice, and you won't have to worry about removing the check mark. Click Save and Close, and now we're ready to bill the client for managing the bounce check. The date of the invoice should be the date that the bank deducted the money from our account. And in this example, we are charging our client $50 because they bounced a check on us. Our bank's fee should be reimbursed, and we should also get something for our time. From the top left, we click New Invoice. And on the same date, for the same customer, Candy, we choose the item processing fee for returned NSF check. And the amount we charge is $50. And again, it might be helpful to add to the description field the check number of the customer's check that you're charging them for. Again, double check that it's not taxable, and when we click Save and Close, we can click Reports, Open Invoice Report, and see that the new $50 invoice that we're charging Candy for the fee is an additional invoice added to Candy's balance. Now let's try a condensed example so you can see how easy it is in a real situation. Let's imagine on April 2nd, the bank reduced our account by $6,000 for a returned NSF check from Alan that was received on February 26th and deposited on February 29th. The bank again charged us a $30 fee, and that's the transaction number, and we need to charge Alan $50 for dealing with this situation. From the top left, we click New Invoice. The date is April 2nd, and the customer is Alan. Now, the first item that we're charging him for is the customer returned NSF check, and that amount is the principal amount of the check, $6,000. But on the same invoice, we can go to the next line and charge Alan the processing fee of $50 that we charge everyone who bounces a check on us. So, 2 steps done in 2 seconds. When we click Save and Close, we can look at the Open Invoice Report and see the entire amount that is invoiced to Alan is on one invoice for the principal amount of the bounce check and the $50 fee. Now all we have to do is record the bank fee, the fee that our bank charged us. We click New, Expense, make sure the date is April 2nd of 2025. You could put the bank as a payee if you want to, but we will just put the reference number and the category will be the expense account that we use for bounce checks and other things. The amount our bank charged us is $30, and it doesn't hurt to track it by customer if you do job costing, but this part here is optional. When we click Save and Close, we can see the bank account has decreased by the $6,000 of the bounce check. And if we scroll all the way down, we can see income from NSF check is $100 for the two $50 fees that we charged both customers for both bounce checks, and bank fees expense is $60, $30 each for each of the two bounce checks.
Chapter 11. Managing Customer Statements.
A customer statement is a document that we periodically give to customers who owe us money. It's like a legal declaration or assertion of what they must pay, and it explains why. Why do we give customers a customer statement? Well, we need to make sure that we agree with the customer regarding what the balance is on exactly the same date that they indicate the same balance. We also need to make sure we agree with the customer regarding how all transactions have been recorded. And it also will help reconcile any differences in our records from the customer records regarding the balance or transactions between the statement dates. So what exactly is on a customer statement? Well, that depends on the type of statement you give. You see, there are three types of statements that you can send. The first one is called a transaction statement, and it's simply a list of transactions during the period of time that's indicated on the statement. So now let's do an example. Let's give Alan a transaction statement between January 1 and January 31 of 2025, and let's see how it looks. From the top left, we click New. We go across to the column of Other and go down and click Statement. Now, I'm filming this very far in the past, so you could click to use the calendar to change the date, and we'll make it January 31 of 2025, or you could highlight and type the date range manually. You can pause the video if you need a moment, but the most important thing to select is this type of statement, transaction statement, which is simply a list of all the transactions that we had between these dates. When we click Apply, we see that there are statements available for all customers. But don't worry about the missing emails. We'll deal with that in a moment. But we can click to remove the statements that we don't want to see. And in order to see the statement of the customer that is selected, we come to the bottom and we click Preview. Now you can see this is the way it would look if you printed it. And of course, if you scroll down, you can see that with Alan, these are the only transactions that we had with him during the month of January of 2025. And it simply lists them in date order. We had these invoices and these sales receipts. And it tells you the amount received if, in fact, it's an invoice or even a payment. So let's close it out and talk about the next type of statement. There's another type of statement called an open item statement. And an open item statement is simply a list of every invoice that's still open and unpaid as of the invoice date. What it will do is it will list the original amount of each invoice and the open amount as of the statement date. So how do we get that one? Well, it's very simple. Leave the date choices and date ranges, leave the customer selected, and simply change the statement type to open item statement. Now, when we click Apply, we get 3 statements available for all 3 customers. But we want to see only Alan. So we click to remove the check mark on the ones that we don't want, and when only Alan is selected for this statement date, for this type, we click Preview, and you can see that during the month of January, we only had these 3 invoices for Alan, and the amount that remains unpaid for all 3 is listed here. Notice number 7 is completely paid off, but number 5 and number 13 are only mostly paid off, and that would clearly indicate to Alan how much is paid for each invoice during this month. So now let's close it out and check the last type of statement. And the last type of statement we can give is a balance forward statement. And a balance forward statement is a list of every transaction you had with the customer during the statement's period of time, but it lists every transaction during the statement period, and it lists it in date order. But the most important thing that this one includes is what's called the running balance. And that means it shows the balance after each transaction. And that's very, very important. It's good for comparing the starting and ending balances to make sure that any disagreements you might have had with the customer are happening during the current period and not a result of any mistake in a prior statement period. So again, all you have to do is, if you selected the statement window and you selected the customer whose statements you want to see, just make sure you chose the right statement date and the right statement type. In this case, balance forward. Notice when you choose balance forward, you need more than just the statement date. You need the start date and end date of the statement. When we click preview, you can see just for actually what just happened, I left these check marks here. So if you click print or preview, it's going to show all 3, Alan's, Betty's, and Candy's. But if we look at Alan's, you can see that during the month of January 2025, okay, because this starts on December 31 of 2024, that means these are all the transactions that happened during 2025. And you can clearly see it lists every transaction and the effect on the balance. An invoice for $3,000 means we owe $3,000. Another invoice means we owe more. Another invoice, we owe more. Another payment, the balance gets lower. A sale receipt does not change the balance. Another sale receipt does not change the balance. But the next invoice changes the balance, and so on. And of course, you could print it and you could email these statements. If you want to email a statement instead of print or preview, all you have to do is put the person's email address right here and click Save and Send, and it will be sent to the customer as a PDF attachment right in their email.
Chapter 12. Reconciling with Customers.
Reconciling with customers means proving your accounts receivable records are correct to the last detail. So what is the customer reconciliation process? Well, it's 3 simple steps. First, you must start from the point that you and your customers agree that your records matched the customer records to the last detail. And usually that moment, the moment that you last agreed, is usually the last statement date. But if you have not been sending statements or reconciling for quite a while, you would have to go back to the very last moment that your records matched your customer records exactly and then reconcile from that point forward. The customer is responsible for reading the statements that we send them and looking at the details and agreeing to the balance owed as of the closing date of the statement. Now, what if they don't agree? If they don't agree, customers must contact you if there's a discrepancy between your records and the customer records regarding what is owed. So, what are the specific steps when working with customers to ensure accuracy? Well, first, you must confirm that the customer has been given either the transaction statement or the balance forward statement, the two statements that we learned about in the prior video. These statements give the customer the ability to read each transaction one by one in date order. By comparing their records to ours in this way, we will find any difference or discrepancy. Then, any difference found, such as a missing transaction or a duplicate transaction or an inaccurate transaction, must be examined and have the source documents for each difference checked by both you and the customer. Now, you could use a statement when you're on the phone with the customer, but the best thing to use when you're comparing each transaction one by one is our good friend, the report we already learned about, Transaction List by Customer. So we click Reports, Custom Reports, and go down to Transaction List by Customer. This is the best one because it lists everything that happened between you and a specific customer during the date range of the report. And you can compare each transaction one by one while you're on the phone with the customer in order to find any discrepancy. So if, for example, this particular payment was different in our records compared to the customer, this report is different than running a statement because this report allows you to double-click on any transaction that is different. And then once you double-click, you can go right back to that transaction and see exactly what happened. You can fix anything in that transaction to make sure it matches with your customer. And once the mistake is fixed, you can print and send an updated statement or updated report to the customer to confirm that you now agree. Now, this procedure is common sense, and it will fix every mistake except one very special mistake. What if the total balance as of the statement date is in agreement with your customer, but the balance of each open invoice on the statement was different in your customer records? In that case, what mistake was made? And once you figure it out, how do you fix that type of mistake? Well, I promise you the answer to that one challenging issue is coming in the next video chapter.
Chapter 13. Fixing Customers' Misapplied Payments.
We know that reconciling with customers means that you're proving the accounts receivable records are correct to the last detail. But a misapplied invoice payment is the only challenging possible mistake in the entire set of customer receivable records. And that's because if you have this mistake, the customer total balances of each invoice will be the same. And if you have this mistake, the customer transaction list will also be the same. In fact, the customer's running balance that we learned about in the prior video will also be the same. The only difference in your records compared to your customers, if you have a misapplied payment, is that the payment will be different in the unpaid open balance of the invoices. For example, I, Mark, purposely went back and misapplied one of Alan's past payments and sent him a statement. Now, if I send him a balance forward statement, he won't know that I misapplied a payment. And that's because this type of statement only shows the amount and the running balance, and there would be no indication that a payment was applied to the wrong invoice. And the customer will agree with every single transaction listed on this type of statement if the only mistake is a misapplied payment. However, if we send them an open item statement, which is another type of statement we learned about in a prior video, you'd be able to compare our open item statement to their open item statement to see if there's any discrepancy. Now clearly, if the full amount is correct, but the open amount is wrong, then obviously somebody applied a payment to the wrong invoice. So what would you do if you notice this type of discrepancy? Well, we know the mistake is somebody applied a payment to the wrong invoice. And we don't know yet if it's our mistake or the customer's mistake. But QuickBooks Online has something great. QuickBooks Online allows you to send a transaction statement. And a transaction statement allows you to compare the amount you received for each invoice to what they indicated was the amount that they paid for each invoice. And by looking at these, you can tell where the payment was misapplied. You can see in our records there were no payments applied to invoice number 5 and $1,300 worth of payment to invoice number 10. But in their records, they had $1,000 applied to invoice number 5 and only $380 applied to invoice number 10. So obviously the payment in the amount of $1,000 is the one that got misapplied. In other words, if I click Reports, Custom Reports, and I open up my favorite report for reconciling with customers, Transaction List by Customer, I can pick any invoice. And by double-clicking on any invoice, I can open it up, for example, invoice number 10. And when we go to any invoice, we can look in the top right corner and we can see how many payments were made and the total applied. In fact, we can even click on this and get a list of each payment that was applied to this particular invoice. Now all we have to do is double click right on the listed payment and we can see exactly how it was applied to the different invoices. So now that we know how to find how each customer's payment was applied, what do? Well, we have to get on the phone with the customer's bookkeeper. We have to open up each payment that we received from the customer and look at it one by one. We have to discuss which invoices were paid from each payment. The party with the mistake should fix it at the moment that you're on the phone. If it's our mistake, we're simply going to uncheck the wrong one and recheck the correct one so that the payments are applied to the proper invoice. And then, of course, once our numbers are correct, we are responsible for sending a customer a corrected statement. And believe me, the best report to do this with is the Transaction List by Customer. So let's imagine we're on the phone with the customer looking at Alan's transactions for the month of January, and we want to see where there is a misapplied payment. And we're going through the list with the customer one by one, opening up only the payments to see where the check marks are applied and see if we agree where we applied the payment. Eventually, we will get to the payment with the difference and the discrepancy. And when we open up that payment and we're on the phone with the customer will confirm that the payment has been applied to the wrong invoice. All we have to do is uncheck the wrong one and recheck the right one. Then after we click Save and Close and click Yes, we can check if the payments are applied by looking right here at the Open Invoice Report. You can see that invoice number 5 now has the correct balance and invoice number 10 now has the correct balance. And now that we've confirmed that everything in the customer records is correct to the last detail, we now have to print and send an updated statement to our customer, Alan.
Chapter 14. Customer Delayed Charges.
A delayed charge is a record of an event where income was earned but should not yet affect any balances. And that means it should not be recorded in the chart of accounts or the customer records until it's billed. This happens when there are too many service events per day or even per week to make an individual invoice. And clients requests that all services and all service events be listed on one invoice per week or even per month. So that's the condition that causes us to need a delayed charge. Now, you may well ask, what happens when we use the delayed charge in real business? Well, if you're going to do it this way, then your customer needs to sign some kind of document from the individual who provided the service that proves that the service was given at that moment. And that would be the source document that you would use to record into QuickBooks the delayed charge. Now, it's better to record each service event as a delayed charge. And then later, when you accumulate all these delayed charges that you perform service that you did not bill yet, you can then add them to the invoice all at once when you're ready to bill the client. Now, how exactly does it work at the moment that you go to record it into QuickBooks Online? Well, it's a record of each event, a separate record of each separate service event that will be billed later in all together on one invoice. A delayed charge will only appear in the transaction list by customer report, and that's because a delayed charge is not a transaction. It's a record of an event, but by itself it's not a transaction, and it doesn't become a transaction that QuickBooks records until you actually place them on an invoice and save the invoice. Now, when you record only a delayed charge will have no effect on any of the customer's balances, nor affect any of the accounts in the chart of accounts. But when you're ready to bill the customer, you can open the new invoice window and you will see all the delayed charges that you made for that particular customer right there. And you can put some or all of them on an invoice just by clicking the mouse. For example, on April 2nd, 5 of Vonda's videographers serviced one big fat job for Alan by doing 2 video hours each at 5 different locations. And let's imagine they all happened on this one day, April 2nd. So we have 5 different events at 5 different locations where Vonda's company earned income, and the client wants them all on one bill, but also wants proof that each separate one did happen. The client therefore requires each videographer to sign their names on a document for the hours worked. And the client's supervisor on each site will also sign the document for the video hours, and they get each a copy. And then you agree to bill Alan on April 3rd and list all of the different individual jobs by name right there on one invoice. And let's use these example names as the 5 different people who perform the 5 different video jobs, and they're basically the subcontractors that Vonda pays for the clients to pay them. So this is the information that we will use to record those 5 events. From the top left, we click New and go down in the Customer column to Delayed Charge. Now, making a delayed charge is almost exactly the same as making an invoice. You have to choose the correct customer. You have to put the date, and in this little example, it's April 2nd of 2025. Now, in this particular delayed charge, we agreed that each of the individual 5 workers did 2 video hours. So for example, this one will be Anna's 2 video hours at that location. So we're going to put here video, and we're going to put 2, and I request, or I advise, let's say, that you make full use of the description field or any memo field that might be there. And in our example, we're not a real company, so the only thing that would be helpful for us to document is the name of the particular worker. But in a real situation, you would describe more, so that unique event will be very identifiable, that Anna was at such and such location doing this specific job. Now, when we click Save and Close, you'll see there's no effect on the trial balance or any of the customer reports that reflect the customer's balance, but it will show on the transaction list by customer. So we go to the section of Alan and we can see the last thing that we recorded was April 2nd, and it was a charge, and Anna was the worker who did it. And of course, in a real situation, there would be more of a description here. So let's do the next few. The next one, we do one for Beth in the exact same way. New, delayed charge. Notice the documents are enumerated. It's still Alan, the customer. It's still the same date, same video wedding, same two, but this time it's Beth. Or any other unique detail about that specific event that it would help to document. And then you click Save and New. We might as well keep it open. Same date, same everything for Christy. So let's do one for Christy. Okay, still the customer, Alan. See, it remembers we do 2 video hours on the same everything. It's very convenient. But event number 3 was done by Christy, and you can put any extra detail. Let's put Christy. That in the real situation, it would help. Save and New. Is there a fourth one? 1, 2, 3, 4. Donna. Okay. For Alan Arby, all things the same, except event number 4 was performed by, and you can put Donna down here. And their name is just an example of what any company, or any data the company might need to put in their particular situation. And Elise. Okay, all of these were done for Alan. The 5th event was done by Elise. Right, let's hope spelling doesn't count and she doesn't get mad. Okay, so when we click Save and Close, there should be absolutely no evidence that these events were recorded unless I open the transaction list by customer report, this one, and scroll down to that particular customer's area. And you can see all the details and the specific delay charge number are shown here. And now let's put them on an invoice. And the result is the same as if you put them all directly on one invoice. And we'll make the date of the invoice April 3rd. From the top left, we click New, Invoice. We make the date April 3rd. We choose Customer Alan, and notice, as soon as we choose Alan, all of the delayed charges we made a moment ago appear right here in the right panel. Now, we could add them one at a time by clicking Add, and notice when you click Add, it actually copies over the description field along with all the other data from the charge. This way, you don't have to type it in again, and you understand more detail about that charge. Now, we could add them one at a time, but it would be more convenient to scroll all the way up and click Add All. Now, all of the delayed charges represent a separate line on this invoice. And notice the total of the invoice is the same, just as if we listed everything ourselves without calling them over from a delayed charge. Now, all we have to do is click Save and Close, And notice how it looks on the transaction list by customer. When you come here, you can see that the invoice is listed as one number. So here are the individual charges, and here's the invoice that actually got created. And when you come over and click Reports and look at that invoice on the Open Invoice Report for Alan, you can see it's listed on Alan's Open Invoice Report just like any other invoice. Now I'd like to leave you with one final note. Once you put a delayed charge on an invoice, it will no longer appear in the right panel when you choose the customer for future invoices. The only two ways to get them back to the panel is to delete the invoices that you put them on or remove them from the invoice. So how would we do that? Well, it's very simple. If I double-click the invoice that has all the delayed charges and I look at the entire list of the charges right here in the body of the invoice, if I want to remove one of the charges from the invoice, I go all the way to the right and I click this garbage can here. And if I click the garbage can, would you like to unlink it? Look what happens as soon as I click yes. Even though it disappeared from the body of the invoice, it immediately was put back in the right panel. Now when I click Save and Close, you can see the invoice has been reduced. And we click Yes. And now it's reduced by the amount of the charge that was taken off. Each one was $600. So this is $600 less. Double click. Now let's fix it just as easily. As soon as I click right here, in the top right, this little arrow will reopen the side panel and you'll see the charge that was put back for Alan. And when we click Add, it goes right back to the invoice, and then we can click Save and Close. Once we do that, all the numbers in all the reports will fix themselves. Just click Yes. And now our Open Invoice Report and our transaction list by customer and everything else is correct. And the real final note about this topic is how interesting the invoice looks after you place on delayed charges and reopen it from the trial balance and the chart of accounts. So if I double click accounts receivable, that doesn't look so unusual. The invoice we just recorded looks like any other invoice when it's listed in the accounts receivable account. However, the other account in the chart of accounts that this invoice is recorded into is video income. Because remember, those workers were doing video jobs on the delayed charges. So when I double click video income and I scroll all the way down to invoice number 24, you can see that each individual delayed charge that was listed on the invoice is listed one by one in the video income account. So even though it's listed in accounts receivable as one number and on the open invoice as one number, when you go to the income account that it relates to, you will see each individual charge just like you were looking at the invoice itself. And we close by confirming that these are the final numbers in your trial balance after recording the delayed charge.
Chapter 15, Delayed Credits.
A delayed credit is exactly the same thing as a delayed charge, but it has the opposite effect. It lowers the item quantity and the money amount of an invoice. And you may well ask, why not just use a credit memo like we learned in earlier videos? Well, some credits are conditional on making a future purchase. Therefore, you cannot decrease the customer's balance or change the account balances until the invoice for the future purchase is made. For example, April 3rd, we created a delayed credit for 10 video hours for Alan to be applied to a future invoice. Let's take a look at how to record it. From the top left, we click New and go down to Delayed Credit. Now notice the automatic enumeration put number 6 because we had 5 prior delayed charges. And of course you can make the number anything you need to make it with your own indexing system. So let's put the date April 3rd of 2025. And we know the customer is Alan, and the service he's getting a delayed credit for is Video 10. And after we push tab, like making any other document, we click Save and Close. Now, as we mentioned before, this is not a transaction until it's placed on an invoice. So what would be the only report that will show this delayed credit after we save it, but before we put it on an invoice? And of course, the answer is Transaction List by Customer. And you'll see it looks very interesting on the Transaction List by Customer. If we scroll all the way down to the bottom of Alan, you can see that the delayed credit uses the same automatic enumeration that follows from the delayed charges. So here's the credit we just made, and here's the invoice we want to apply it to. That brings us to our example continued. Let's imagine an unrelated incident with Alan, and one of the video workers caused an issue that called for a concession with Alan, the great customer. To settle the problem, Vonda agreed to apply the delayed credit that we just made to a past invoice instead. So let's imagine we're going to apply it to invoice number 24 from April 3rd. So please note, however, if you reopen a saved invoice, the available delayed credits and charges will not show in the side panel. You must make a new invoice. Let me show you what I mean. If I double-click on this existing invoice for Alan, notice I do not see, in fact, even if I zoom out, I do not see the credit appearing, the delayed credit appearing in the right panel. That's because you have to make a new invoice. And the invoice will be a negative money amount indicating a credit to the customer's balance. And it's going to stay that way until it's applied. So let's take a look at how to make the new invoice. Close this one out, and we click New Invoice. The customer again is Alan, but this time the date is April 3rd. But notice, as soon as we chose Alan, the credit that we created appeared in the right panel because this is a brand new invoice. And we can click either Add or Add All, and the credit goes on the invoice, and it makes the invoice money amount negative. So once we have all the information we need on the invoice that we're using to make this credit an actual transaction, then we can click Save and Close. And when we come back to the transaction list by customer, we can see that the credit and the invoice that we plan to apply the credit to are right next to each other, right here. Now, when we apply the negative invoice that was caused by the delayed credit, the action is exactly the same as when we applied a credit memo to an existing invoice. We use the Receive Payments window and we make a $0 payment. And we do it for the same customer on the same date, just like we learned before. So when we click New, Receive Payment, we can leave the date and make sure we choose Alan Arby. Now notice what happens as soon as we choose the right customer. What happens is we're going to have to scroll out or zoom out a little. Oh, not that far. Okay. And you can see as soon as we chose Allen, in the top section, you have the invoices. And just like we learned before, in the bottom section here, it shows the credits. And a negative invoice counts as a credit. And this invoice became negative because we put the delayed credit on it. So QuickBooks Online knows we're using it, so it makes the check mark here, but it doesn't know which ones we're using it for. So we have to uncheck the wrong ones, and we have to go and recheck the correct one. The correct one is the one that we just made right here. Click on it and make sure that the only two check marks are on the negative invoice and the positive invoice we're applying it to. You also must make sure that the amount received is 0. So it looks just like it did before. Amount received 0. The amount applied to an invoice is $3,000. And the amount of credit used is $3,000. 0 in amount received, $3,000 on the invoice we're applying it to, and $3,000 on the negative invoice that we're using like a credit. And we click Save and Close. And now we check the results in the Open Invoice Report. When we go back to Open Invoice in the section of Allen, we can see that neither the credit nor the invoice it was applied to appear on the open invoice because they have both been used, and only what remains on the open invoice is what has not yet been paid. And as always, we close by confirming that these are the numbers in your trial balance after you finish the whole process of working with delayed credits.
Chapter 16. Writing off uncollectible accounts.
When a customer's balance is determined to be uncollectible, it must be removed or written off from your accounts receivable records. This determination, of course, also affects your chart of accounts. So what happens when you write off an uncollectible account? Well, we know that accounts receivable is what reflects the customer's balance. And if they don't owe you the money once you determine you're not getting paid, you have to record a decrease to both the customer's balance and the accounts receivable account in the chart of accounts. And at the moment you write off the customer's balance, you have a new expense called bad debt expense. And the bad debt expense increases by the amount of the customer's account that you just wrote off. So you may well ask, what is bad debt expense? Well, it's an expense that you incur at the moment it is determined that a customer's balance is uncollectible. When it is clear that you will lose the future expected funds that the customer was obligated to pay, the correct thing to do is record bad debt expense. Do not delete the original invoice that they cannot pay. Do not remove the income that was recorded with that invoice. You legitimately earned that income for an event that happened, so that income has to stay there. The proper way is to leave it there and record bad debt expense. Now, this bad debt expense is slightly different than the other expenses that we have been working with before. It's what we call an other expense because it's not part of normal operations. We need this expense to show at the very bottom of the profit and loss below operating income because this expense doesn't really reflect how well we're operating. It's just bad luck that we had a customer who couldn't pay. So let's go ahead and put this in the chart of accounts. From the top right, we click the cog wheel and we go over to chart of accounts. Once we're in chart of accounts, we click new. Now, of course, the general category is expense, but watch very carefully. We're not going to put expense. We're going to scroll down and put other expense, if it lets us.
other expense. Now, as far as the detail type, since there's no bad debt expense listed here, which would be great, we can simply choose other miscellaneous expenses. And of course, we have to put the name bad debt expense. And you can pause the video if you need a moment to type it in and make the right choices here, and then click Save. Now that it's on the list of accounts, we'll discuss the two different ways that you can record writing off uncollectible accounts. You could either use the journal entry method or use the credit item method. Both methods will make a credit that will show up in the open invoice report that you can then apply to the uncollectible invoices. And the way to apply that credit is to use our good friend, the receive payment window, just like we learned earlier in the course. So let's record two specific invoices so we can use one of each method of write-off to demonstrate how it works. Let's imagine we have a new customer named Danny Deadbeat. And let's imagine on April 5th, we did 10 video for him because we did not know that he wasn't going to pay. From the top left, we click New, Invoice. The date is April 5th of 2025. Now there's a new customer that's not on the list, and when we click the pull down, we're able to add new customers on the fly by clicking Add New. Now in this case, we will only put his name, but you can come back and type in all the other data that you want if you want to make him a customer, but he's not going to stick around long. So let's just put his name so we can add him as part of the transaction and click Save. Now we can finish this invoice like any other invoice. We click the pull down arrow and scroll down to Video Wedding, 10, and push Tab. Now for this one, we click Save and Close. Now let's imagine on April 6th, he wants another job, 10 editing hours, and we don't yet know that he's going to stiff us in the future. So we record that invoice as well. New, Invoice. Danny's already on the list. And it's an editing item. The date is 1 day later, April 6th. And the number of units is 10. Now we click Save and Close. And this is what the trial balance looks like after those two invoices to Danny. Now let's find out how to do this. The journal entry method requires that you make a journal entry. Now we're going to learn much more about journal entries later in the course. But if you never learned about journal entries or accounting, this method is still very simple. You see, you open the journal entry window, and of course, you have to record bad debt expense in the amount of the customer's balance. However, you have to record it in the debit column. And you might have noticed, even though you never took accounting before, that when we look at the trial balance, all of the expenses are listed in the debit column. So that should help you remember that you always debit an expense. That's if you choose to use this method, which means you have to credit the other account we talked about earlier, the other account that gets affected by writing off the customer's balance is accounts receivable. And as I just mentioned, we are crediting the account of the customer. So that should help you remember that accounts receivable, which represents the customer's balance, gets credited when a customer is written off. And QuickBooks Online knows which specific customer is getting written off by putting their name right on the same line in the row of accounts receivable. So you're telling QuickBooks that it's accounts receivable and this specific customer whose balance is being credited and being written off. So let's use the journal entry method to write off the April 5th invoice. And when we come back to this, you're going to see a credit in the amount of $3,000. And I promise you, we will learn more about journal entries later on. But for now, just follow step by step. In the top left, we click New, and we go over to Journal Entry. Now, what date are we writing off? Well, we'll just use April 7th, the very next day. And the account that we're going to put the expense, click here, BAD, bad debt expense. The amount of the first invoice that we're writing off is $3,000. Then on the next line, click below, and here's where you have to choose Accounts Receivable. Notice QuickBooks Online knows that to balance the entry, you need $3,000. And on the same row, you choose that particular customer, Danny Deadbeat. It's as simple as that. Now when you click Save and Close, you can come back to the Open Invoice Report specifically for Danny, and you can see that there is now a minus, a credit, that should offset the balance of this invoice, but it has not yet been applied. We now have to apply the two together so they wipe each other out and they don't show up on the Open Invoice Report. But before we do that, let's just confirm that it was recorded properly in the trial balance. When you click Reports and you open your trial balance, you can see that bad debt expense shows up for the first time in the amount of $3,000. And it's all the way here on the bottom below everything else because it is an other expense. In fact, if you click Reports and you go down to the Profit and Loss and click Profit and Loss, and of course we want the results of all dates, Run Report. Now when we scroll to the bottom section, we notice here is net operating income. Let's zoom in a little. So this number is really the reflection of our normal operations. But we had some income that does not relate to normal operations. That was the NSF check from the prior videos. And here we have expenses that do not relate to normal operations. And that's what happens when you choose other income or other expense for the account type. So now that we know the result, let's apply this credit that we just made to the open invoice. And we do that the way we learned all along. We use our good friend, the Receive Payment window. So I'll scroll out a little and click New, Receive Payment. Now we leave the date and we have to choose the customer, Danny Deadbeat. And as soon as we choose Danny, we can see that this time the Receive Payment window got it right. This time the Receive Payment window knew that this journal entry that's basically a credit to Danny's account should be applied to the oldest invoice right here. And when we save this window on the same date that we recorded the journal entry, all you have to do is make sure that the check marks are on the journal entry and the correct invoice, the money amounts in full are in the payment fields, and the amount received is 0. Then all you have to do is click Save and Close. And you can see that both the journal entry and the invoice are now gone from the Open Invoice Report. Now, let's try the credit item method. Now, the reason that we have to really learn the credit item method is because some companies have too many write-offs to wait for an accountant to adjust for them at the end of the month. Some may prefer a document that actually can be printed and signed, and a journal entry is not really a document. So the credit write-off method is more appropriate when it happens a lot and you need more documentation. So how does it work? Well, first you have to make an item on the products and service list, and the name of the item can be uncollectible customer account. Then as you make the item, you have to connect it to the new expense that we just created, bad debt expense. Then all you have to do is make a credit memo and put the item on the memo with the amount of the customer's balance, and then apply it to the open invoices, just like we just did. So now let's write off the April 6th invoice from Danny. So how do we do that? Well, we're going to have to first go to the cogwheel, come over to the lists of products and services. Now this is a new item and it is a service, and the name is exactly what we said. We called it Uncollectible Customers Account. And you can right click for the spelling. You can even put non-collectible, but the most important thing is that this is connected to BAD, bad debt expense. You probably also want to make sure that it's not taxable. So if you click here, you can come down. It's not taxable. We click done. You don't want to have tax added to it. And then we click save and close. Now we're ready to write off the April 6th invoice from Danny. And we do that by making a credit memo. We click new and we go down to credit memo. The date is April 7th and the customer is our good friend Danny Deadbeat. Now, the item that we choose from the product and service list is this item that we just created, non-collectible customers account. And the amount we're writing off with this specific credit memo is $1,400. Push tab, and when we click save and close, we can see that both the credit memo and the invoice are both listed open because we have not yet applied them to each other. But at the moment we click new, receive payment, we can choose Danny Deadbeat, and notice the window gets it right again. The credit memo of $1,400 is automatically applied to invoice number 27, and notice they're both check marked with the full amount in the payment field and amount received 0. Now we click save and close. And now we can see on the open invoice report, Danny Deadbeat is completely removed and owes us nothing according to our records, and everything is written off. And the final trial balance should look just like this, where you can see the bad debt expense down here for both of the invoices that we wrote off for Danny.